Good day fellow traders and value investors, and welcome back to another video. Today we continue our series Start with the A's. In today's video we'll look at Realty Income, ticker O, and we'll be asking, Realty Income pays dividend every single month, but does that make it a safe Warren Buffett-style investment? Or just an expensive bond in disguise? Let's get into it. Realty Income is not the REIT, but just like Apple in tech, Realty Income is the stock everyone compares other REITs to. One of my friends once said that Realty Income is the benchmark for REITs, and the more you study it, the more that statement makes sense. Over 15,500 commercial real estate properties, over 1,600 clients in 92 industries and multiple countries. This makes Realty Income less dependent on any single tenant, less volatile than smaller REITs, and a proxy for average high-quality REIT behavior. Realty Income's dividend gets all the headlines, but the real story is in revenue, margins and growth drivers. Let's see whether this business is earning more or just paying its cash out. Q3 2025 total revenue of 1.47 billion compared to 1.3 same quarter last year. 9 months that was 4.2 billion compared to 3.9 the 9 months in 2024. Available funds from operation 1.08 compared to 1.05 the same quarter last year. And it is flat because Realty Income grows through acquisition, and to fund the acquisitions they issue more shares as one of the means. The dividend payout ratio is 74.7% out of the diluted available funds from operation per share. So as you can see, dividends are covered by real cash flow, not financial engineering. We'll now look at the financials in trading view as well. We'll look at revenue first. We can see it's growing steadily over the last few quarters. But if we change to annual, I notice something. We see the revenue has been growing double digits over a few years, but net income has been staying flat pretty much. Over the last few years it stayed at around 800-900 million. And that's due to a few reasons. We have to understand how Realty Income grows. They do that through acquisition, and they fund the acquisition through two methods. One is by issuing more shares. We can see the diluted share outstanding has been growing from 289 million to 860, but that does not affect the net income, that affects the per share data. What affects the net income is the second method. They fund the acquisition, that's through borrowings from banks, through credits. And we can see that total interest expense has been growing from 300 million to 1.12 billion. The second thing that does affect the net income is the amortization. That's one way that accounting punishes the growth. So we can see that revenue has been growing, whilst at the same time the depreciation and amortization has been growing from 500 million to 2.5 billion. And that's because the more building the company has, the higher the amortization depreciation goes up. This is not a cash charge. We can look at the cash flow. We can see that the free cash flow has also been growing from 900 million to 3.6 billion. We'll quickly look at the assets as well. Pretty good assets, growing from 15 billion to 68. Obviously they are real estate companies, so the more real estate they own, the higher the assets. The net debt has been growing as well from 6 billion to 28 billion. In the balance sheet I've seen that their liquidity is at 5.4, but we can see in here that they have quite a bit of debt. Long-term debt growing from 6 billion to 26 billion. We'll switch to the statistic quickly as well. We can see that the stock is selling for a price to earning of 52-53, and it's been in the 50s over the last few years. It went up to 80 in 2021 and it went down in 44 in 2022. Net margin pretty solid of 21%, and debt to equity, I'm not sure how we can take this one considering that debt is how they fund their acquisition, but in trading view it says the debt to equity is 0.74. I had to research to find the current ratio, but it's at around 1.3-1.6. So fundamentally Realty Income is a high quality, predictable business, but that alone doesn't make it a great investment. The next question is the most important one. How much should you pay for this quality? Let's look at the intrinsic value now. Valuation shouldn't be fear-driven or hope-driven. We'll walk through 3 valuation frameworks and then 3 clear scenarios so you can see risk and reward side by side. Let's start with valuation using Warren Buffett, Phil Town and Peter Lynch's valuation methods. Warren Buffett's method focuses on book value per share, cash flow in the form of dividends to shareholders, and compares that to 10 years discount rate. And we can see it returns a undervalued rating. Stock is currently selling for about $56 per share, and according to Warren Buffett's calculator, its intrinsic value is at 65.45. Field Town method focuses on expected long-term EPS growth. I use a very optimistic growth of 12%, what I found on the internet for the next 5 years. Discount back to a reasonable rate, 50% discount, and that returns a intrinsic value of $21 per share. Quite a bit to drop from the current price. And Peter Lynch's method focuses on price to earning growth, price to earning, and then we use the same growth rate, plus the dividend yield. So Lynch's view will likely be good business, not a runway growth stock, and the price reflects that. We get an overvalued rating using Peter Lynch's intrinsic value calculator. So as you can see, using these three methods, we get a fair value range between $21 per share and $65 per share. And for the 3 case scenarios, I use cost of capital and acquisition spread as the key driver, because Realty Income grows by raising money and buying properties. If interest rates fall and the stock is valued well, Realty Income can buy assets at higher yields than its funding cost, which will result in better EPS, AFFO growth. If rate stays high or the stock is cheap, growth slows. For a bear case scenarios, I use EPS growth of 0%, so pretty much staying flat. If interest rates stay high and funds from operation lag, EPS may barely move, so we could see the price of around $42 per share. In a base case scenario with EPS growing at 3%, slight expansion via acquisition, plus some internal rent growth, we can see earnings per share going to 124 in 5 years, and stock could be selling at 64.5 in 5 years. And in a bull case scenario, DPS growing at 5%, lower rates, easier access to capital, re-rating by investors, we could see earnings per share go to 137 in 5 years, and the stock could be selling for 81.94 in 5 years. Putting it all into a probability weighted table, we can see that we can get a total of 13% return over the next 5 years if we buy the stock at current levels. That will make it compounded 2.44. Adding 5.66 dividend yield that it currently gives, we can get a 7-8% from the stock if we buy it at current levels. So the business is durable, dividends are well covered, and the intrinsic value suggests a fair to undervalued range today. This wouldn't be a complete analysis if we didn't talk about the risks. Let's look at the risk facing Realty Income and whether any of them change the long-term story. First one that I've identified is share-based compensation. When I was researching, I found that over the last 3-5 years, the share-based compensation was going up, and it was about 21.7 million in 2025. It's important because it dilutes the shareholders, but this is not a red flag because I also looked at the insider trading and I didn't see a lot of selling, so it means that the management is not bearish on the company but bullish. There was more buying than selling. The second one is the interest rate sensitivity. We've already looked at it and discussed the way that company grows is by borrowing money through the banks, or one of the way. The more money they borrow, the more interest they pay, and that results in lower net income as we've seen earlier. They don't break the business, they just slow it down. Tenant stress and impairments. There is a little bit of impairment tied to bankruptcy and asset sales as part of portfolio repositioning. That indicates to me more of a portfolio cleanup than crisis. This is housekeeping, not structural decay. And finally, Europe and FX exposure. I've seen through the presentation that they are expanding through Europe because it offers a better yield, but that also exposes them to the currency fluctuation. Realty Income's risks are not about survival, they're about pace. Higher rates slow growth, tenant issues require cleanup, and stock-based compensation deserves monitoring. But none of these risks undermine the durability of the business itself. Even Warren Buffett cares about when he buys, not to trade, but to avoid overpaying. So let's have a look at the charts and see what the technicals are telling us about the stock. As we can see, it's already crossed below the 55 moving average and it's signaling an exit from the current position. We recently printed long 1, long 2, long 3, but it just failed today. If we look at the moving averages, they are still pointing up. The ATR is printing below the bar. That's telling us that the trend is still upwards. There is upward momentum still. There is no complete capitulation. If you look at the MACD, you can see the MACD is pointing downwards. Histogram has rolled over to negative and is building momentum downward. And both signal and MACD are below 50%, which tells us that the momentum has cooled down. If we'll zoom out just a little bit, we can see that since 2019-2020, the stock has not moved at all. has been moving sideways for about 5-6 years. So if you are a trader or a speculative investor, you'd have not made any money unless you had a strategy that works better on a shorter time frames. I'm using weekly time frame. We can also see that it found some resistance at about 44-45 level. He broke through it, he came back and used it as support on a couple of occasions. This was the pandemic, obviously. It bounced off of the 44 and then it found further resistance at about $60 per share. But it remains to see if it will break through that resistance. If it will, I'll be looking for MACD to point upwards. I would look for a longer period of time with sustained momentum behind it, ATR behind the bars, moving averages pointing upwards and the stock continuously moving away from the fast moving averages. So as we can see from the chart, the business is solid, but the stock isn't screaming buy aggressively right now based on my indicators. So when you put it all together, fundamentally, Realty Income is a durable Buffett-style business. Technically, it's telling us to be patient. This combination suggests us that as a long-term investor, hold or accumulate carefully. As new investors, wait for better alignment. And for traders, this is not a high probability setup right now. So to answer the question we started this video with, Realty Income only becomes a bond in disguise when investors stop caring about price. As long as you respect valuation and timing, it remains a high-quality business, not a yield trap. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.